Good morning everyone. My name is Amatul Musfira. I am student of Bachelor of Business Administration at Jairaj Jannabakyam College for Women's. Today I am presenting on the topic Security Analysis and Portfolio Management. Let's start with the meaning of derivatives. Derivatives are financial contract whose value is derived from a underlying assets such as stocks, bonds, commodities or currencies rather than owning the assets directly. Partners agreed on future terms based on its price movements. Example, if you enter in a contract to buying gold at 16,000 per 10 gram after 3 months, then contract is a derivatives based its value depends on the future price of gold. A derivatives is a contract between two parties whom price is based on another assets. First, forward contract, private agreement between two parties, customized, trade over the counter, OTC. And next one is future, standard contract, traded on a stock exchange, example Nifty futures. And next one is option contract, giving the rights not obligation to buying or selling, two parties, call option, put option. And another one is swap contract, agreement to exchange cash flow, common in interest rate and currency markets. Next, I would like to talk about the growth of derivatives market. Derivatives trading in index starts in 2000. 2000 index future introduction on Nifty 50. 2001 stock options and stock futures started. Trading begins on National Stock Exchange of India NSE. Last introduction in Bombay Stock Exchange BSE. The derivatives market has grown rapidly due to increased risk in financial market, globalization, technological advancement in India. Derivatives trading starts in 2000 with the index future on Nifty and NSE. Today, India is one of the largest derivatives market in the world. Now let's move on to its global development. 1917, the Chicago Mercantile Exchange launched currency futures. 1973, the Chicago Board Option Exchange stands stock options trading. 1980s, rapid growth in interest rate swaps and currency swaps. 1990s, expansions of derivatives worldwide due to globalization and financial innovation. 2018, after the 2018 financial crisis, stricter regulations were introduced, but derivatives continues the expand under the supervision. Next, I would like to talk about derivatives in portfolio management. Tactical allocation. Tactical allocation is an active strategy when investors temporarily adjusting sector or geographically exposure to take advantage of short-term market opportunity. And next, risk management. Risk management is the process of identifying, measuring and reducing investment risk to protect portfolio values. And next one, cost efficiency. Cost efficiency in portfolio management means achieving full market exposure with a lower transaction cost by using derivatives investment in terms of the directly buying and underlying assets. And next one, income generation, writing, selling options, earn premiums, strategy for boosting returns in standard market condition. Next, start with the equity options of risk control, real world application. Portfolio managers use equity put options as a cost effective investment policy against sudden market drops. How it works? Buying put options on a stock index sets a floor on portfolio losses during volatile periods without recurring the sales of any holdings. This preserves long-term investment positions while providing immediate downside protection. Limitations and risk of derivatives. Complexity. Derivatives are powerful tools, but they are not simple investment. They require strong technological knowledge. Without proper understanding, misuse can lead to financial losses. Leveraging assets. Simple price movements in underlying assets can proud outer side gains or losses, dramatically magnifying portfolio by on Indian value. Third point is counterparty risk. OTC derivatives carry by risk than the other parties may defeat contractual obligation, a systematic contract with during market stress events. Fourth point is market risk amplification. Without proper oversight, derivative can amplify exposure dangerously as demonstrated during the 2008 financial crisis. Regulatory challenges. Difficult to regulate complex investment. Financial innovations moves faster than regulation. Market volatility can amplify price fluctuation, increase short-term instability. Lack of transparency. Many derivatives are trading OTC, over the counter, limited public information, difficult to measure total market exposure. Thank you.